Navigating the financial frontier, harnessing options and futures in investment strategies. In the ever-evolving landscape of finance, investors seek tools that not only enhance returns but also provide avenues for risk management and strategic positioning. Options and futures, often regarded as sophisticated financial instruments, offer investors a unique set of tools to navigate the complexities of the market. Understanding how investors can harness the power of options and futures in their investment strategy requires unraveling the intricacies of these derivatives and discerning their application in a strategic investment framework. Options unveiled. Options, a subset of derivatives, grant investors the right, but not the obligation, to buy or sell an asset at a predetermined price within a specified timeframe. The two primary types of options are call options, which provide the right to buy an asset, and put options, which confer the right to sell. Investors employ options for various purposes, including speculation, income generation, and risk mitigation. One common strategy involving options is the covered call. In this scenario, an investor who owns a stock sells call options against it. If the stock price remains below the predetermined strike price, the investor keeps the premium earned from selling the call options, providing an additional income stream. However, if the stock surpasses the strike price, the investor may have to sell the stock but retains the premium, potentially mitigating losses. Futures in focus. Futures, another category of derivatives, represent contractual agreements to buy or sell an asset at a predetermined price on a future date. Unlike options, futures obligate both parties to the contract to fulfill the terms of the agreement. Futures contracts span various asset classes, including commodities, currencies, and financial instruments, offering investors a diverse range of opportunities. Consider an investor seeking to hedge against the volatility of commodity prices. By entering into a futures contract, the investor locks in a price today for the purchase or sale of the commodity at a future date. This hedges against adverse price movements, providing stability and predictability in the face of market fluctuations. Futures contracts, therefore, serve as valuable risk management tools for investors looking to safeguard their portfolios against price volatility. Strategic applications. Options and futures find their place in investment strategies through a multitude of applications. Investors can use options to enhance portfolio returns, mitigate risk, and generate income. For instance, a protective put strategy involves buying a put option to hedge against potential losses in a stock position. If the stock price declines, the put option serves as a form of insurance, limiting the downside risk. In the realm of futures, investors often turn to these instruments for speculative purposes or to gain exposure to specific markets without the need for direct ownership of the underlying assets. For example, an investor bullish on the future price of gold may enter into a gold futures contract. If the price rises, the investor can profit from the price appreciation without physically owning the gold. The options futures dynamic duo. Combining options and futures within an investment strategy can unlock synergies and provide a more comprehensive risk management framework. Consider a scenario where an investor holds a diversified portfolio of stocks and wants to protect against a market downturn. By employing a strategy known as a protective collar, the investor can simultaneously buy put options to hedge against potential losses while selling call options to generate income. This nuanced approach leverages the strengths of both options and futures to create a balanced and resilient portfolio. Leverage and risk considerations, asterisk. While options and futures offer powerful tools, they come with inherent risks, particularly related to leverage. Options and futures contracts allow investors to control a larger position with a relatively small amount of capital. While this magnifies potential returns, it also amplifies losses. Investors must exercise caution and thoroughly understand the risks before incorporating derivatives into their strategy. For instance, a leveraged option strategy can lead to substantial losses if the market moves unfavorably. It is imperative for investors to conduct thorough research, employ risk management measures, and potentially seek professional advice when integrating options and futures into their investment arsenal. Asterisk the evolving landscape, asterisk. The landscape of options and futures continues to evolve, with financial innovation introducing new instruments and strategies. From index options to commodity futures, investors have an expanding toolkit to tailor their approach to the ever-shifting dynamics of the market. However, with this expansion comes the importance of continuous education and staying abreast of market developments to navigate the intricacies of these financial instruments effectively. In conclusion, options and futures, when wielded judiciously, can be powerful tools in an investor's arsenal. From hedging against market volatility to generating income and enhancing returns, these derivatives offer a spectrum of strategic possibilities. However, as with any financial instrument, a nuanced understanding of the mechanics, risks, and strategic applications is essential. Investors who master the art of integrating options and futures into their investment strategies can unlock new dimensions of portfolio management, positioning themselves to navigate the complex and dynamic currents of the financial markets with skill and confidence.